Hi, Jimmy. How are you?
2024, Jeremy, I'm doing great.
It's official. Here we are. We're doing the market insights for the first quarter here in the new year, and looking forward to having a good long form discussion with you about where we're going.
Can't wait.
So, we kind of always do this. We set it up with sort of our top three themes that we're going to talk about this quarter. This one here, we're going to talk about the new year, the new outlook. Also, balanced growth. That'll be where we dive into a lot of the charts and the fun numbers. And then we'll pivot off of numbers and go into a little bit more of the psychological side of it all and talk about geopolitics.
Always a fun conversation.
No doubt. All right, so we got the opportunity to learn a little bit from our friends at JP Morgan just recently, and we're big fans of Dr. David Kelly, who is their chief strategist, right?
Yeah, I've been following Dr. Kelly for years. I mean, really, I think since I got into the business, I've been following his work. He's a regular contributor in a lot of financial media outlets, but he has a phenomenal research team supporting him. And we kind of like the simplicity of the information provided here of what he is hoping for and really what he's expecting with his 2024 analysis here at 2% GDP, 0% of a recession, which certainly is giving a tip of the cap to the Federal Reserve, and maybe we have been able to finagle this soft landing as we've heard about so often. 2% inflation target for 2024, and slightly softening labor with unemployment rising ever so slightly to a 4% level from its current level.
Yeah, it's a good way for them to describe what 2024 looks like. And of course, there's a lot of different analysts out there, very respectable individuals with great teams. Not only do we respect them, but we incorporate their thinking into our thinking as well. We just highlighted what Dr. Kelly here had to bring to the table.
Yes.
So the first one is the economy. And when we talk about the economy, we talk about gross domestic product. And so you got a good slide here. We've looked at this one before. You're not going to see a big amount of changes here quarter over quarter on this thing.
That's right. I mean, I think the big thing that jumps out at you on the bar chart on the right is that we are a consumer-driven economy, right? I mean, 67, almost 68% of the economy is driven by consumption. You and I and others going out and spending money is good for the economy. I also think that one of the important things that take it a note here is, you look at this trend growth of 2%, over the long-term average, and if you look at some of the time periods of how long we grew below that trend line, actually corresponded with phenomenal market performance.
It did.
So again, I think it's important to take a look at the economy, talk about it, understand it, but be able to disassociate it from the stock market.
Well put. It's just the economy and the stock market are two different worlds. Sometimes they maybe orbit around the same sun,
right,
in some respects, but they are two different worlds.
No question.
Inflation. God almighty. Have
Yes.
we talked a lot about inflation?
A lot.
So maybe we'll get to the point where we're not talking so much about inflation. And I kind of think that we're starting to see those trend lines here.
Well, that's the hope. I mean, when you look at this, you can clearly see it looks like a little bit of a bell curve with maybe a little bit fatter tails than normally expected in a bell curve. But we were looking for inflation for a long time. And the Fed thinking is when you cut interest rates to stimulate the economy, you'd expect inflation to follow. It just didn't for a very long time, and then it jumped up and grabbed us in a very big way, which it's obviously had the corresponding effect of the Federal Reserve raising interest rates at an unprecedented rate to cool things down, and it does seem like we are trending in the right direction.
I kind of chuckle at this. Your buddy Steve Leisman?
Yeah.
So you met him out at Future Proof.
That's right.
And I took a picture of you guys, and he's a really smart guy, and he was on television the other day, and he said, new rule. A new rule is, we can have a situation where you have continued growth in the economy at the same time that you're raising interest rates. to fight back inflation.
Yeah.
Right? New rule.
Right.
I mean, so because the fact of the matter is, growth continued. We didn't have to, seemingly at this stage in the game, we did not have to kill the economy
Right.
in order to stifle inflation.
Right. You heard, what if, they're going to keep raising rates until something breaks? Well, nothing really broke. We had a few chinks in the armor there. We had like the Silicon Valley Bank last year, and you had potentially a scare with the regional banks, but that didn't come to fruition. And again, so far, so good.
And it might not be as rosy as what it sounds like for future environments, because this was mostly a supply-based inflation shock.
Yep.
But look we seem to have gotten through the fog. We're starting to get in the clear. We'll take it. All right. So how do we look? What's the environment here? And we bring this slide in from the Capital Group because we think it shows a couple different things. Number one, your economies are always going through cycles, right? So
Right.
There's early, mid, late, and recessionary. Kind of then you trough, and then you start to grow, and then you peak, and then you go through the same kind of roller coaster like cycle.
That's right.
So here we are, right? Different global economies and different spaces on that roller coaster ride.
Here we are. So the U.S. is the biggest bubble there, is the largest economy, but we're in the later stages of the growth of the economy. If you want to use a baseball analogy, we're in the later innings of the game, right?
Yep.
We're certainly not first pitch here, but you look at where the U.S. is compared and contrasted against a lot of the other economies that India's an economy and a country we've been hearing a lot about. Had a lot of growth last year. There's been a lot of discussion of the potential growth in India. Further behind us. Then you got somebody like Germany, who's one of the largest and most important stock markets and economies outside of the U.S. And they're showing to be in a recessionary environment right now. But that also means that they're usually not far from troughing and starting to rally and getting that early stage again.
Right. And so again, there's opportunities in every single point in the cycle.
Right.
So you might actually say great time to buy on the Eurozone, great time to buy a developed international, because it's a little bit lower priced than what it would probably be a year, 2, 3, 4, 5 years from now.
Absolutely.
We're going to make the switch and talk about balanced growth in particular. And again, this is where we'll get into some of the charts. All right. So this is really cool, really relevant to where we are today. We have now visited the Fed has told us, like, really, that we're in a pause moment. We've had the last raise in rates that we're going to see for the foreseeable future.
Yep.
The most likely thing is going to be a cut at some point in the future, to be determined.
Right.
So what do we know about the history of similar environments? Well, here it is. The dark blue is 1 year following that final Fed hike. The light blue is 5 years following that. And these are annualized returns.
Right. So, obviously what jumps out at you see, cash was such a popular or like buzz investment last year because, what was it? Ray Dalio, I believe, had said cash isn't trash anymore.
Right.
Right. When you had the Federal Reserve raising interest rates on the front end of the curve so much, all of a sudden you can get real yield, and people were getting really excited about CD rates and Treasury rates and things of that nature. But when you're looking at this, and if you take the Fed at their word, and we are the next move is likely to be a cut, well, look at the returns speak for themselves. The cash is not really where you'd like to be. Over 5 years, you're going to get a lot more return in other investments, but particularly look at the 5-year numbers on the 60-40 on the blend, on that balance, right? So stocks and bonds. The bonds, in theory, providing a risk reduction to your equity allocation and not having to sacrifice a whole lot in the way of performance.
That's the one that my eye goes to immediately when I see this. I'm like, sure. I mean, it doesn't surprise me with the U.S. stocks, core bonds. Hey, you know what? Some good returns there. Really, there is. But when you talk about risk adjusted, for you take a look at your overall portfolio, beta, it's like, geez, to take 60-40 and get 14% in the next year. And then long term, 8.4 on a 60/40.
Right.
Yeah, most people would take that straight to the bank.
I would agree.
So it's really interesting to look at these. I think it's important to keep these historicals in mind. These are some of the best comparisons that I think you're going to ever get into when you start looking at these sort of historical moments and then what takes place afterwards.
Absolutely.
This is a common slide for us. It's nothing we have to go into with great detail. It's that risk versus return piece, and how do you apply this to an individual portfolio, right?
Right. So we just looked at 60/40 was the primary benchmark that we saw in that last slide. But here we're just noting, in a financial planning software that, the one that we utilize, we're able to see and analyze different average rates of return and volatility and the standard deviation of those asset allocations. And, again, we always believe they should be making developing a financial plan before you figure out your investment plan, right? And so this always comes back to the core of who we are.
It does, and it allows you as an investor a lot more control than maybe what you would think that you would have. Sure, the individual market, the bond market, the stock market, or whatever it might be, at any given point in time, you don't have a lot of control over that.
No, absolutely.
Virtually zero,
yeah,
right?
No.
And yet you do have control over your own portfolio, and this is one of the best ways. It's a dial up, dial down.
Absolutely.
Right? I'm either going to put more risk on with stocks, or I'm going to put more. I'm going to take some risk off the table, and I'm going to fill up my fixed income bucket a little bit more.
Right. Exactly.
Another common viewpoint that
one.
we look at. Yeah, this is the periodic table
That's
of sorts, and the asset class returns, and you can start to look at this now through. From all the way back to 2009 up through last year,
Yep.
right? And so, what are those annualized, kind of returns? What asset class performed the best? And if you're talking about something like a 60/40, that's the white tiles in here. That's a 60/40, and once again, 60/40 is not for everybody.
For
right?
sure.
Number one, but it's a nice balanced portfolio, and you can see how it performs.
Well, again, this is where we jokingly say, being diversified means having to always say you're sorry for something.
Yeah.
Because you're never going to be, at the top, but you're also never going to be at the bottom. And I think that's what's interesting is when you blend this out over a long period of time. This is the way that the math is interesting, that you do get like an above average return out of the 60/40 portfolio, but a well below average volatility in the portfolio. So as opposed to investing in a single asset class, you're able to keep the volatility, below average, and your return is actually above average.
Yes, and you're participative in almost all of these different asset classes when you're in, an asset allocated kind of mix, like a 60/40.
Right.
You have a little bit of everything.
Absolutely.
Right? And as you can see, there's a big reason for that. Commodities, some years, commodities tend to flip-flop between the top and the bottom. Just one example. REITs tend to do the same, right?
Yep.
A lot of the other asset classes, large cap has been very good for a long time. Small cap, mid cap, all these, right? They fall at some point on the spectrum.
Yeah.
Right. We don't know exactly. Nobody would sit here and tell you exactly they know what's going to happen in the next year, right? If you asked most people what was going to happen in 2023, nobody would have told you what actually happened, I don't think.
If you knew what was going to happen, and if we knew a year ago what the economy or what was going to unfold throughout the course of the year, it would have been difficult to predict the stock market doing what it did. But I think one of the other key things I take away from this is, listen, what worked last year isn't necessarily what's going to work this year. And the necessity of you assessing the portfolio, identifying when something is maybe a little rich in value, and maybe you need to trim an allocation there where it's performed very well, and finding something that maybe didn't perform as well in the prior year or prior years, but that maybe has some good growth prospects for the future.
All right, now the S&P 500. As we know, this is the large cap stocks, and these are always fascinating to look at. There's so much money tied up in the S&P 500, and one of the things that we're looking at here is we're looking at price to earnings valuations, and how do they compare. And in particular, one of the things that one of the knocks on the stock market in 2023 was that, hey man, it was just all driven by the Magnificent Seven,
Right.
Those top seven, stocks. In this particular slide, we're actually looking at the top 10 stocks, which includes a little bit more diversity than just those tech stocks.
Right.
But the point is still valid, right? They drove a lot of the growth that you had in 2023.
Sure. But there's a lot of other companies underneath there that are still doing pretty well.
That's right.
From an earnings perspective and from the potential of a broadening of stock market participation and having the other 490 companies in there, you can start to see a world in which those other 490 companies that are make the overall price to earnings valuation of the S&P 500 not uber rich, maybe see them starting to participate and a little bit more in the growth in the future.
Spot on. So that speaks to our theme around balanced growth, right? We see things, and this is all cyclical in some respects. Like people are going to want to participate with some of these stocks that are they're a little cheaper on a whole, right?
Yeah.
I mean, now is a better time to buy into that, right? There's some people who are advocating in 2024. Hey, look at the equal weighted, not the cap weighted, S&P 500, right?
Well, that's what we saw, right? Like 2022, the equal weighted would have done better than the market weighted, and then in 2023, the exact opposite was what we experienced.
Yeah, and we don't have a real strong kind of proposition point around that, to be honest with you, right? You could make arguments either way.
We're not saying don't own the Magnificent Seven.
We're not.
We're
not, because it's one of the things that I think is really important to discuss is that every year we predict the decline, the demise, or at least the cooling off of some of these stocks, and it just seems like it doesn't happen. Now, what you need to know is that owning those guys means higher volatility rates, right?
Right.
And when you have a downturn in the market, they are gonna rip downward a lot faster than the other guys.
For sure.
And that happened.
And well, look, and here's a positive point to spin on that is when you have an index like the S&P 500 that rebalances by kicking out companies that aren't doing well and adding those that do well, it's sort of owning the index sort of helps take care of some of that picking, for you.
It really, really does. It's a dynamic place to have your money, and it's always part of that asset allocated portfolio that we talk about. So then we just talked about the large cap, S&P 500.
Yep.
Now let's talk about the small and mid cap. When you're looking at these, sometimes they're referred to as the S&P 400, the S&P 600. So what's happened here is we're looking at the last 3 months, and these guys, the small cap and mid cap, experienced a nice rally.
Yeah, it was actually jarring to look at. So this chart is the last 3 months, but if you looked at all of 2023, basically all of the return for the small and mid cap companies came in the fourth quarter. They had sort of had some small gains in the early part of the year, and then we had this seasonal adjustment in September, and they kind of bottomed in October, and then my goodness, November and December just ripped for the small and mid-cap stocks. So it is nice to see when you talk about a broadening of the market and the participation of these other companies that make up these indexes, where you're actually seeing outperformance relative to the large cap, especially when you think about the dominance that the large cap has had over the last decade and a half that we saw from the periodic table of returns. The large cap stocks are the top asset class. Well, here you're starting to see some outperformance from their small and mid cap counterparts.
Yeah, and maybe it's a little bit bluer skies for them in the immediate term because what happens to the small cap guys and the mid cap guys as well. You're going to have a lot more sensitivity to those interest rates. A lot of those big companies can wash off interest rates. They've got pricing power. They can do a lot of different things, right? These smaller guys are much more, they're much more sensitive to the credit markets.
For sure.
And then on top of that, you had the bank crisis that we experienced maybe it seems like a blip on the radar screen, but it wasn't for these guys. It had a much greater impact.
Absolutely. And then on the flip side of that, to your point of like the sensitivity to the rate hikes, what happens if we do start getting rate cuts? These companies that have been, less loved, they seek to benefit possibly in a greater proportion than the large cap companies.
Great point. And that speaks exactly to why in Q1 here of 2024, taking an eye at the small cap, mid cap companies is going to be really important for your portfolio. Absolutely. If you don't have them in there, you really need to consider getting some allocation to them. Developed international. So we're not going to talk about is emerging markets right now.
Right.
Okay.
Yep.
That's a whole different thing, and we're not talking about it because we don't really see. Look, people should have an allocation to it. It should be small at this juncture. We don't.
Sure.
China. There's a lot of storm clouds there. We don't want to really touch a lot of the emerging market right now in a appreciable way.
Sure.
But the developed international market, we feel a lot more strongly about, don't we?
Yeah, and so what you're looking at here is a chart. So we always like to look at the technical analysis, right, and looking at the chart. So we sort of drown out all of that economic noise, and we're just looking at the price of the benchmark. And so what you'll see is the purple line is the benchmark. The orange line on the top is the 200-day moving average of the benchmark. And the blue line that sort of goes in the middle there, that is the 50-day moving average. And so the theory behind this is the 50-day moving average is sort of drowns out some of the noise of what's going on in the recency bias, but the 200-day is a much more telling threshold there. And when we go to the next slide, we're going to look at why has the purple line dropped below the 50-day and the 200-day in the last month or so here, and the U.S. dollar dynamics have a lot to do with that. So you see that the international stocks, the index there has dipped below the 50 and 200-day moving average for a short period of time. Maybe it bounces back up above. It's something that we certainly keep an eye on. But when we look at the next chart and you focus on where you see that purple line dropping off, you're going to see a very high correlation when you look at the next slide with the U.S. dollar.
Absolutely. And then just one other point I want to make is this is a 6-month chart. If you look at like international over the last few years, right, it's starting to show signs of sort of a resurgence that we can kind of see a little bit. And again, the dollar always plays a role in that.
No question.
So here we are with the dollar, right? So it's sort of an opposite kind of reaction here to the dollar. Again, the purple line is the dollar itself.
Yep.
Blue is the 50-day. 200-day is the orange.
Right. So where you see the purple clearly cross back over and breaks out of beyond the 50-day moving average. That was the same spot in the previous graph that you saw the international index breaking below.
Right.
The question is, though, if you, to your point, this is not a very long-term chart. If you look at it over longer periods of time, do you believe the dollar is in more of a longer uptrend or downtrend? And those are things that you do need to assess when you're building your allocation to international equities.
Yeah, and we're not pretending to be currency experts here.
No, not
That's
at
a
all.
very, very dynamic environment. But there are a lot of smart people who are predicting a little softening in the U.S. dollar.
Right.
All right. So international still is part of this slide here. This is about valuations and dividend yields. And let's talk about the one on the left, component on the left.
So the left side here, what this is showing is showing our home country bias. Okay, so U.S. investors tend to value U.S. companies more so than they do international companies. Buy what you know, right? I think that's a mantra that's utilized by a number of retail investors. But the fact of the matter is, U.S. stocks are held at a premium relative to international stocks, and the discount that you see right now for the international stocks is more than 2 standard deviations from the long-term average. We've shown this slide before. We think it's very important to keep an eye on because over long periods of time we do tend to believe in reversion to the mean. And so what you're seeing there is then maybe this is a really good buying opportunity if you do believe in a long-term reversion to the mean and getting back to that average. That would typically mean you'd get some nice outperformance with international stocks.
Right. And this is looking at the benchmark. So you're kind of encapsulating all of these companies within it, right?
Absolutely.
Outside of the United States. And one of the arguments that we've actually made is that, there's nothing wrong with the benchmark on the international developed. It's good. It may be an even better approach to look at some active management where they're selecting certain companies within the mix of international companies that are really rock stars.
Absolutely.
Because there's great examples of companies that are just great across the board. They might be domiciled in Europe as an example, but most of their business is actually in the United States.
Yeah, you think about companies like Nestle, right? Mm-hmm. I remember drinking Nestle chocolate milk as a kid, but it's not domiciled in the United States,
right.
So it's an international stock.
Right. Right. And I mean, hey, not to pick on Boeing right now, but would you rather own Airbus or Boeing right now?
Right.
You know what I mean? So,
No question.
so here's, there's always good examples of opportunity areas within the international space. And then their dividends tend to be higher paying
Right.
relative to the United States. And that's what the chart on the right here is showing.
There's less tech companies over in the international index. The U.S. markets are, as we showed before, there's a high concentration in tech stocks. Tech companies tend to pay lower dividends, so over internationally, you're going to get higher dividend yields. And again, right now, you're 2 standard deviations beyond your long-term average on the dividend yield. So lower prices, higher dividend yields, potentially some attractive opportunities there.
It's a really good value space to be in, if nothing else, right?
Yes.
Okay, now we're making the switch over here to look at bonds. In particular, this is the U.S. Treasury market, and this is actually from several months ago at the end of September. I wanted to show you because, in particular, take a look at the differential, the spread between the blue line and the green line. Right, the green line is from the end of 2022. Blue is from the end of Q3.
Right.
And so there's a decent amount of delta between those two.
Right.
Note that.
Yep.
Now, in this slide, here's the most recent numbers. A lot of convergence, right?
Yeah.
That thing collapsed like a pancake.
Sure did. In one quarter.
Yes.
And so now what I see when I'm looking at this, all right, we've converged quite a bit on the long run, on the long end of the curve. We still are inverted, but if you do take the Fed at their word that we're going to start, that the next move is most likely going to be rate cuts, they're going to be doing that on the front end of the curve. And so I think it's relatively easy for you to start to see how we could start working our way back to a more normal looking or normal sloping yield curve.
Yeah, it's and therein lies the reason why we've got a little bit of a band around in orange there around the 2 to 10 year mark.
Right.
Okay, we think that as you're looking at bonds right now, you should be looking in that kind of midterm space to buy with a little bit more duration associated with it. So you can be the beneficiary of locking in a rate that's probably more attractive today than it might be 6 months from now.
Right.
Number one.
Yep.
Number two, there's some upside possibilities with respect to where the market goes.
Absolutely.
And that speaks to this right here.
Yeah.
Right. So on the left-hand side, we've got sort of all of our latest data at the on yields as of, I think it's the 19th of January.
Right.
Right. And then on the right side, walk me through this. This is an impact of 1% rise or fall in the interest rate and what that does.
Right, exactly. So let's just take a step back. So we know that bond prices have an inverse relationship to interest rates. When interest rates go up, bond prices are going to fall. When interest rates go down, bond prices should go up. So what you're looking at here are a variety of different types of fixed income investments, ranging from a 2-year Treasury all the way to leverage loans. You've got high yield bonds in there. You have investment grade corporate bonds. You have long-term Treasuries. And what you're going to see is, the blue line here shows if we have a 1% fall in interest rates, you should expect to see price appreciation. The bond prices are going to go up. And if we were to see on the gray line there a 1% rise in interest rates, you're going to have a reduction in the price or a depreciation of the value of your investment. So the largest movements are going to be those with the longest duration or the longest term of the bond. They're more sensitive to the interest rate risk. But you're starting to see a lot of spaces here within fixed income where if we do get a 1% decline in interest rates, you can get pretty good price appreciation. And even if we did get a 1% increase in rates, which is certainly not at all the base case, there's not a lot of opportunity there for you to lose a lot of money unless you were in a 30-year super long-term Treasury.
Yeah, your sensitivity on that 30 years is pretty good. But yeah, I agree with you, right? I mean, it's really interesting to see what the upshot is here on bonds. There's an opportunistic play in
balanced
bonds.
growth, right? That's, as you said.
Balanced growth, absolutely. And so it's not untenable. Look, people can argue all day about when is the Fed going to cut? How much are they going to cut in 2024, if at all?
Yep.
There's all sorts of bets out there.
Yep.
I don't think it's unreasonable to have an argument that would say over the course of the next 11 months that we're going to see to 50 basis point cuts from the Fed.
Right.
That would be not unexpected. That actually might be light compared to what most people would say.
I would say you're certainly on the light side of most prognosticators.
You're light, so then you take that 1% fall in the interest rates, and you're holding the U.S. aggregate.
Yeah.
You've got an 11% increase in
The price
capital
bonds.
gain. The price
Right.
appreciates by 11%, just like that.
It's a pretty good deal.
Pretty awesome.
Yeah.
Right. So it's an opportunity that's kind of sitting out there and waiting for it to spring.
Right.
All right. Well, we're going to make that switch now. We're going to go a little bit more qualitative on this and go into the investor psychology piece with some geopolitical discussions.
Yep.
So politics.
Fun,
boy,
fun.
oh boy. I mean, it's 2024, which means it's a presidential election year, which means we're all going to be inundated with all sorts of attack ads, and we're going to be, whether we want to see these things or not, they're going to run across our small screens, our big screens. We're going to be exposed to it.
I'm dreading those text messages.
In my opinion, it's a lot of nonsense. We get a lot of noise, not a lot of signal out of politics.
Absolutely.
And so we are trying very much so to take some of that emotion out of it. Look, Jimmy and I don't care about Republican versus Democrat versus independent. It's not our job, right? Our job is in money management. Yeah. And so we have to be data driven around this. And so that's what we're trying to do here, giving you an idea. What happens with the government control and how does that affect the economic situation? Well, that's the top part of this, the real GDP. You've got three different scenarios. One's where the Republicans are in full charge of the government.
Right.
Presidential in the House and the Senate. The other one is the Democrats are fully in charge, and what happens most of the time is a divided government.
Some sort of split.
So here we are, right? So when the Republicans are in full charge, it's 2.8%. It's 4% when the Democrats are in full charge, and most of the time it's 2.7% because that's a divided government. That's what's happened 60% of the time.
Almost two-thirds.
Almost two-thirds of the time.
And this is going all the way back to 1947, so it's not like we have a small sample size here.
Exactly. Okay, so there's a little bit of difference there, but let's be honest. Most of the time it's going to be a divided government. It is what it is.
That long of a time horizon, not a big deal.
S&P 500, a little bit different, but really kind of the same. I mean, the Republicans actually do, and I think maybe sometimes the Republicans get this credit, but remember, it has to be all branches of the government.
Right.
And that only happens 10% of the time. Their average return on the stock market, S&P 500, is 12.9%. You compare that to the divided government and the Democratic government. Yeah, there's a difference there.
Right.
Right. But again, 61% of the time, it's divided government. It's 8.3. All these numbers stand up to reason.
Absolutely. Well said.
All right. So what does it mean for dollars and cents and your portfolio?
Yeah.
Right. So I think this is actually the way better slide to talk about this, because we're saying, what if you invest $10,000 in the S&P 500, and then 10 years after that, what does it look like? How much have you earned? This gives you all the different kind of bands of years out there. But the most important stat is the one sort of in the middle in that box. It says average 10-year annualized return. For Democrats, it's 11.2. For Republicans, it's 10.5. Statistically, is that meaningful? I can't answer that question off the bat, but what I can say is it doesn't sound like it is.
Well, when the data set here goes all the way back to 1936, the answer is no, right? I mean, it just isn't that big of a deal. So again, this is certainly an area that gets people charged up emotionally. But what we're trying to do here is apply objective data to the portfolio management, and just to say, we don't get moved by the political movements, whether it's blue or red. In the long run, it tends to even out in the wash.
There you go. So guys, remember that is really a big deal here in 2024 when we get slammed with all of this stuff, all of this. Sometimes it's information, sometimes it's misinformation. But let's stay true to the course and stay true to the numbers and keep our heads wrapped around that. That's the biggest deal. Both of us like this.
Yeah.
We kind of say, world on fire? Sure is. Feels like it a lot of times. There's always something going on. And if you go back in history, you could mark data points on, the stock market and say, gosh, how are we going to move forward when we have Black Monday? How are we going to move forward when we have the global financial crisis? Oh my God, what about COVID-19? Oh my God, what about the Israel-Palestinian Hamas, latest blow up in the Middle East?
Right.
What next?
Well, I think when I look at this thing, this is kind of I always say, like, this is the story that's told that the stock market tends to climb a wall of worry, right? And so, as I mentioned earlier, who would have predicted the market returns we would have had in 2023 if you would have known what was going to happen in 2023, right? Where no interest rate cuts in 2023. Actually, we had more rate increases, which is in theory not good for the stock market or the bond market. And then we added a new conflict to the chart here. We've got Israel and Palestine on here, and yet we had over 20% returns in the S&P 500. You had robust gains in all equity markets across the board. And if I would have told you at the beginning of last year, it would have been really tough to wrap your mind around growth, and certainly not growth to the extent that we had it. So again, there's always reasons to be worried with the stock market. There's never green lights across the board saying you're good to go. Go ahead and put all your money in now. It just does not work that way. So sometimes you have to be willing to close your nose, plug your nose a little bit and stay invested.
And look, we get it, right? I mean,
oh, yeah.
What we want you all to know is that we're all human beings here, right? We all have an emotional dial. We've all made mistakes when it comes to investing, and that's okay, but you can learn from that. And
right.
We're hoping to impart that upon others is that, don't make the mistakes of the past, right? Stay cool and stay calm, and everything's going to work out. And I think you'll love the next slide because of this encapsulated the whole thing perfectly. So bottom line.
Yeah, don't worry.
Line. Bob Marley says it. Don't worry.
Make a plan.
I'm not sure he said make a plan, but you know what?
But that's, again, that comes back to what we said, though, right? Like, this is, like, you need to have a plan built for you that helps you, create context for how you should be invested. And I like what Bob has to say here.
He's right. And, and so please, at the end of the day, try to make your own plan.
Right.
If you need help making a plan, we're always here at On Track Wealth Management to do that. That's what financial planners like Jimmy and I do. And we're more than happy to dive into your particular situation to customize a plan for you so that we can have you not worrying about geopolitics too.
Exactly. Well said.
Well, that's it, folks. Thanks everybody for tuning in and listening to Q1. We will be back again with Q2. In the meantime, take a look at our Between Two Fiduciaries videos that come out every other week about, on average. We've got a lot of great shorter snippets in there.
Right.
So good luck, everybody, and have a great 2024.